Yeah, right. But they refinanced the house and got the money for it. So 3.5% more.
Yeah.
I wonder too long.
You and I have the exact same question.
Really?
Yeah, I have to do all that on my plate.
What's that?
Yeah. So,
Yeah, we can talk about that. I want to know the correlation between them winning 4 games and the replacement reps being there like 4 games, right? And then what happens? So that's the story. Yeah.
No idea what.
All right, you want to start the recording?
First recording.
Okay, perfect. So, in full disclosure, I should tell you we are all being recorded right now. We have a bunch of clients from out of state who are joining us via GoToMeeting. They can see the screen and they can hear everything that's going on. So feel free to opine as you wish, but you're on record. Okay. So tonight, thanks for coming. This is actually this gives us a really good test of the capacity of this room. Like we're just about to full capacity, which is good. So tonight we're going to do a little bit of a kickoff meeting. Alex, Merrick, me, I, will be presenting. Ryden will also be presenting, and Scene will do a little bit of presenting as well. Margaret, who many of you know, Margaret Stallworthy in the back, is obviously a CPA. For those of you who don't know, is a CPA to whom we turn quite a bit for help and guidance. So I want to, yeah, totally. That's very good. So that says enough about how we feel about Margaret. This is wonderful. So we'll get to that in a moment here. But if anybody is interested in exploring a new relationship with a tax advisor or somebody who you can feel comfortable knowing that we will be acting in a coordinated effort, we would highly recommend maybe you speak with Margaret here as tax time's coming up, I understand. Yeah. Okay, so tonight we're going to spend a lot of time talking about what has and has not yet been decided as far as the fiscal cliff. So we'll have a lot of focuses on that. Here's a disclosure. Please bring the printout so you can read. Again, thanks to Margaret, really for more than just your help in this presentation, but it's really your help in the go back up to see. Also, a lot of the numbers were taken out of the Journal of Accountancy, so credit should be given to, I hope I'm saying these names correctly, Paul Bonner and Alistair Nevius. That sounds like a smart guy to me, right there. I do that just screams smart. So, at any rate, some of the numbers aren't from there. So, tonight we'll be talking about what happened very briefly in 2012. Talk about fiscal cliff decisions that have been decided up until this point, what is left to be decided, major changes for 2013 as far as taxes are concerned, and opportunities and concerns ahead, which Scene will talk about related to the market. I envision this to be kind of an open dialogue sort of meeting, so if questions come up, I think as opposed to holding them to the end, I think we can have a kind of an open dialogue about things because there's so much in terms of material that we want to cover. So let's talk a little bit about the year in review last year. Before we get there, actually, I really like this slide. And for any of you who have worked with us for a few years or more, you may remember when we had a small gathering of about 80 people at Monty's Steakhouse back in January of 2009. And the reason why there was so much interest was not their lovely steaks. It was the fact that the stock market was in complete shambles. The real estate market may have been worse, and there was not a lot of direction out there. We had so many people call us between probably October of 08 through March, April of 09 with real major concerns about the world being different than it's ever been before. And the guidance that we provided was 2 things can happen, right? First, everything fails, the rest of the world fails, everything's worthless, maybe even cash, and you're worried about your safety. You'd probably try to get your munitions, but I understand that might be harder to do now. I don't know enough about it. I just heard things are going back and forth as of today. By the way, I should state, we're not really wanting this to be a political oriented discussion, although, feel free, I guess, but I really want to talk about kind of the facts and things that have happened. The guidance that we gave was that the U.S. and the world economies would recover, and stocks would outperform bonds, which would outperform cash. And from that period of time, if we look on a point-to-point basis, all of those things are true. There have certainly been pockets of time where bonds outperform stocks and so on. But I think this really speaks to how we all feel in times of challenge in the market, where a lot of people were wondering if the question was if, as opposed to when things would recover. Will we ever recover? Lo and behold, we're at a 5-year high in the market, I believe, today, because we did finish up just slightly on the S&P. So I like to remember these times a little bit, because I think valuable lessons were learned during that period of time. because it's our feeling, we don't know when this will happen, but we will be seeing the opposite of fear in the markets, which is greed. We need to be able to have as much rationality, I guess, about that as we do in periods of time when things are very fearful. Right? I think maybe have somebody who's trying to get in. Great, next slide. I think it's pretty fair to say that the last 10 years have been challenging. It's been a pretty tough environment. It's been a very, very tough environment for stocks. And I was thinking just today when I was on a review that the first time we were at 1,500 on the S&P was in the year 2000, right? So it's at 13 years, right? Earnings growth has doubled over that period of time. If the market is still at a different level, it's really caused people to have a different view, I believe, on stocks and really give up faith to a degree on how stocks operate. What's so important is for any of you who work with us, which is most of the room, you know that we operate using an investment policy statement. You know that we care as much about bonds as we do about equities as we do about alternative investments, because diversification has proven even over this tumultuous decade to work. These are all different asset classes, and this will tell you a cumulative return over the past 10 years. This will tell you the annualized return of what those asset classes would have provided. This is an emerging markets category. Real estate investment trust. Russell 2000 is small cap. This is Europe, Australia, and the Far East, believe it or not, right? Over the past 10 years, Europe, which is in such shambles, has outperformed the U.S. market, or the S&P 500 during that period of time. Barclays aggregate is like an all-cap bond index, if you will. Market neutral, which portfolios contain, are managed in a fashion where some stocks are bought long, some are bought, or some are sold short. Commodities, so that could be gold, could be oil, could be agriculture, and then finally cash at the bottom, okay, and this shows you a cumulative rate of return. What's sort of fascinating about this, we call this the periodic table of investment returns for obvious reasons. It sort of looks like that, but what's so interesting is to see that in periods of time, you know, here we are, 07 and 08, what didn't do so well? Real estate investment trust. Next year it was third to worst, right? But then where we see some of the leading, some of the lagging sectors can oftentimes be those that lead us back, which makes market timing and trying to pick sectors really, really difficult. So I would encourage all of you to look at this asset allocation, which is never going to be on the top, and it's never going to be on the bottom, never say never. Unlikely will you see an allocation that is balanced, and this would be a 55% equity, 45% bond portfolio. What you're noticing here is we're not going to be hitting it, it's not like my golf game over here and down there. It's kind of straight down the middle, right? And that's how we're constructing portfolios. So an asset allocation model over the past 10 years has frankly done pretty well, averaging 8.1% per year. So I think it's neat to kind of look back at a period where we've seen the worst pullback in the market since the Great Depression. I think it was even worse than 73 to 75 over this last period, yet still using an asset allocation model works. So, okay, so let's talk about the fiscal cliff. We're all sick of hearing about the fiscal cliff, I think. I wish you're sick of countdown clocks and all that part, especially when it seems like we run right up to these deadlines every single year, and I know we've joked about that over time. We have a little ongoing joke about this crystal ball and whether it'll ever become more clear, if it has cracks, or if we just dropped it. We don't know. But what the fiscal cliff is it's a combination of really two things in general. It's a combination of cuts, typically cuts that we saw in 01 and 03 that have been kind of referred to as the Bush tax cuts, right? And across-the-board government spending cuts that was all expected to occur by 1/1 of 13. The idea of the cliff is that these two events, had they occurred as planned, which they did not, they could have triggered a really detrimental economic position. Really, it could have pushed us back into a recession. I had heard numbers around 4% to 5% of lost GDP if these two things had happened. So we're not out of the woods. Not everything has been decided. But let's talk about some things that have. Now, this past, I get a kick out of the, I don't know, Margaret, what you think, but I get a kick out of the name the American Taxpayer Relief Act, since there's no relief in it at all. I think there's only an increase in tax from what I can see. Passed the Senate, which we all knew, I think, pretty decisively, and I will say it passed the House fairly decisively as well. when it all came down to it. A couple of interesting facts. Obama signed this into law on the 2nd from his Hawaiian vacation home. He used an auto pen, so I really I don't know. This is really my favorite. The term fiscal cliff has been included in the 38th annual list of words to be banished from Queen's English. Misuse, overuse, and general uselessness. This is from Lake Superior University, I believe. They do this every year. Other banished words were thankfully bucket list, spoiler alert, I'm going to tell you what's going to happen. Here's a spoiler alert. Superfood, and I never heard of YOLO. You only live once. I hadn't seen that, but had I received that, I would say it shall be banished. So that's how I feel about that. So anyway, we're all sick of hearing about it. 150 pages of legislation, which included increases in federal taxes, Social Security taxes, and potentially capital gains taxes. It extended unemployment benefits. There are a few million people who are on the precipice of losing those benefits. They were extended. It prevented doctors, I believe that number was 27 or 28% is what they would have gotten in terms of a cut in terms of reimbursements for Medicare. It extended federal dairy assistance, which doesn't seem like a really big deal. It's a big deal to people who can barely afford milk. So,
Are these all permanent now? These changes all permanent, or are they just temporary for a year or two?
I would say nothing's permanent, but right now these are in law. These are clause in law. Correct me if I'm wrong, but I believe these are all permanent changes until there's a new bill introduced.
Right.
Yes.
That's law.
Yep.
Temporarily permanent.
Yeah, they're temporarily. I love that. Yeah, that's great. It delays the sequestration or spending cuts, okay, and this is one of the concerns we'll talk about. It pushed them back 2 months. It pushed them back until the 1st of March. So that has not been decided. That is not clear yet. I love this one. It did cancel a scheduled pay raise for members of Congress. That's cool.
They should get their money back.
Yeah, they could do that too. A couple of other things we need to worry about. So again, we have 2-month reprieve until the automatic spending cuts are expected to occur.
Things into law.
What's that?
It was thinged into law.
All right, this is a pretty good time. This is a good time for a story. I gave a workshop one. I love doing this stuff, right? And I gave a workshop, and my in-laws came, and I was trying to spell the word fidelity, and I got it wrong in the presentation. They got a real kick out of the fact that I can't even spell fidelity, therefore I couldn't spell infidelity. So yeah, I know. So we were singing this into law. Man, spell check wouldn't catch that, would it, huh? So the bill was singed into law, should have, on 1/2 of 13, as we know, but we still need to worry about these spending cuts, and there's more to follow on that. What we're looking at is roughly 10% across the board of government spending cuts. Roughly half to defense and half to non-defense. There was a term I looked up because I had forgotten what it was. I think it's innumeric. Innumeric is a term for numbers that really, it's hard to conceptualize in our brain, numbers that are either way too big or way too small. That's why I wrote out what $85 billion looks like. Now, Margaret and Scene, I think Scene in particular, will probably talk a little bit about the $16.4 trillion debt ceiling limit. This is probably the next bit of potential headwind that we have because I believe, this is February 15th?
Around February 15th.
On February 15th is basically when we're going to reach this limit. And I should tell you all, this is not for any new money. This is money that's already been spent by the government, okay? Let's hope we're not a deadbeat nation and that we don't honor the checks we've already written. That's sort of a little bit of opinion here. Moving on. Okay, so let's talk about some of the major changes. Really what they did is they reversed or got rid of temporary changes that President Bush had put into place back in 2001 and then also in 2003, many of which were expected to sunset in the year 2010, but they got extended 2 more years because it would have been a really bad time to do anything that could run the economy January 1st, 2010. We know that. So it permanently extended many of those things, including the 10% bracket. I don't know if you guys remember, it was either 01 or 03 when you got a check back halfway through the year, either $300 or $600 if you were single or married, because they had implemented a new bracket of 10%. Previously, the low bracket was 15. So if you were married, I think you got $600 back as a refund because they did this in the middle of the year to basically true you up for the first part of the year. That 10% bracket is now permanent, which is really great. It also permanently fixes the AMT or alternative minimum tax. I will certainly defer to Margaret on this if people have questions, but I know that the AMT was something that was created in the 50s or 60s.
Yeah, quite a while back, and the idea, of course, was to make sure that people who were able to structure their tax lives in such a way that they paid little or no income tax would pay something by saying certain things are just not allowed under the alternative system. Well, it had two problems. One of them was that since when did living in a high income tax state with high property taxes and having several children equate to tax planning?
Right.
But those are three of the things that are not allowed as deductions from the alternative system. They haven't done anything about that. But what they did do is raise the original exemption was not indexed for inflation.
Right.
So you figure if you're looking at a number that was good in the 50s, and here we are now, it made no sense.
Sure.
So they bumped it up again, and now they put an
Condition
automatic indexing thing on it.
As opposed to coming back to it every year, right?
Yeah, exactly.
Okay. So that's helpful. One thing, just on the phone with a gentleman before our meeting, and he said, "So this fiscal cliff stuff on here talking about it tonight, will this really affect me?" And I said, "Well, you may have seen one change already." And he goes, "Oh yeah, my check's lower." Okay. Payroll tax holiday, which I believe happened in 2010. I'm not sure when it originally occurred. I believe in 2010. Where we were given a 2% reprieve on a portion of the income that we earn that goes to Social Security. Okay, so I don't know what the income cap is, 110 or 120,000 now, I believe. You will pay 6.2% on your income up until that point, and then above that you're going to have to pay unlimited 1.45% tax, and there's a little bit of change to that as well. But the previous couple of years we've only been paying 4.2%. So imagine a couple family making $50,000, $75,000. This really is $1,000, $1,500 increase in tax. So all this talk of if nothing, if we go over this cliff, all Americans will be affected. That's one of the main areas where we really all will be.
One side note on that, that program cost the Social Security program about $230 billion over the past 2 years is what they're estimating. They don't know the numbers for 2012 yet, but it's right around 230 to 240, 250 billion dollars. Basically, we now have funded into the Social Security trust less because we had this holiday. So now we're just getting back to that.
Right.
If they make it whole, which they at some point said they would do,
Right.
it means that much money's got to be found in general revenue, put back into the fund.
Well, here's one place to find it, from the rich people. Everyone's sick to hear about that, who's rich, who's not rich, right? Little, yeah, little tough. You've seen the roof. Let him hang himself at 39.6. No, there is a new tax rate. And
I'd be happy to pay that.
All right.
If I were making that much money.
All right, thank you. Yeah. There is a new tax bracket. Actually, it's not a new tax bracket. It's an old tax bracket that used to exist that is now back. And the big question, right, was who's rich? 200,000, a million, 250, a million, right? There was this big tug of war happening. It was decided that single filers who make 400,000 or joint filers at 450 will be paying more. So you're a couple and you each are very fortunate and you make $300,000 a piece. There's no penalty to getting married. I'm not trying to talk anybody into decisions, a lot of them. But at any rate, that is fact. So the next slide that we have will go through and show you the brackets. I don't have anything to write on here, but I think we probably all understand that these brackets are progressive, and every person earning income, if you're married and you file jointly, I use the 2012 numbers because I didn't have 2013. They're going to be very close to this inflation adjusted, right? I mean, they'll be very close. Taxable $1 through 17.4 is taxed at 10%, right? 2000, the year 2000, this didn't exist, right? Now it's permanently extended. That's a wonderful thing. 17.4 to 70,700 at 15, and so on. These all look really similar, except for what happens down here. In 2012, if you made over $388,350 as a married couple, you pay 35% on those, on any dollar above that, okay? What has changed is now the 35% bracket will end at $450,000 for married people, and the new 39.6% bracket applies. So that's a big hit, I think. I think I'd seen on CNBC for somebody making $500,000, a couple making $500,000, something like 17 grand more in taxes. It was a big number, I thought.
Doesn't change for lifestyle.
Yeah, I guess. I mean, yeah, probably not. I don't know. It's one of these not in my backyard things, you know, that you learn about. We put this slide in here to show you, and it's here twice, later in the presentation as well. So what happened, right, if we extended, right, 2013? Well, we went right back up to this line of around 40%. But check this out, guys. Look at how often in history, since 1911, I believe is when this progressive tax system happened, look how frequently we're over a 40% rate. In fact, in the 50s, I believe this rate was 91%. Okay, if you made over, the highest bracket was 91. That's pretty rough. So, putting it in historical terms, these taxes are still very favorable compared to where they have been in history. So, Ryden will touch a little bit more on that when we talk about Roth IRA and conversion. There still are opportunities, but I think that's interesting to look out. All right, other changes that happened in 2013. Excuse me, phase out of itemized deduction starts at $250,000 single, $300,000 married. Okay. There was confusion about a lot of these things and saying, okay, this $450,000, that's where you start to get hit with all this different stuff. That's not the case, right? That's not $450, that's $300 or $250. The state and gift tax, it was retained at $5 million in index for inflation. Last year was actually $5.12 million. That's great. And then the rate went up a little bit from 35 to 40, but it's a lot better than going back to what it reverted to, which I believe was a $1 million exemption. Just really not that much when you start to include life insurance and homes and all those sorts of things. This is a big one, and it's a big one for folks in this room. Unreimbursed, I thought this was so sneaky. This was me thinking this is a great way to raise money without it looking like too big of an issue. That's my opinion. Unreimbursed medical care expenses, you could itemize those as deductions if they were over 7.5% of your adjusted gross income. Well, that goes up to 10% now. Okay? There are going to be a lot of people, I think, kind of caught in that window, right? Maybe it was 8 or 9%, but it wasn't quite 10. There are some exceptions if you're going to turn 65 between 2013 and 16, but I will tell you that long-term care premiums fall into this category. Okay? I had read something fairly creative, which talked a little bit about funding a flexible spending account or help, you know, an HSA or something, and using those, that's pre-tax, using those dollars to pay long-term care premiums if possible. That way you can take advantage of the deduction, even if you're not at that 10% of HDI. So I thought that was kind of a, I don't know, when I was talking to guys about this, I thought, boy, that's a real get shot.
Yeah, and you have to be very careful of that because the HSA rules are very, very tight on what you can and cannot pay from those accounts. So if you're going to think about that strategy, you want to make sure that a long-term care premium is eligible because in general, it doesn't allow you to pay medical health insurance premiums.
I would consult a good tax advisor.
Yeah.
I think so. But
back up 1 second. There's something at the bottom there. Very important to be clear that the thing they're talking about limiting at $2,500 is the flexible spending account deduction from payroll for somebody who's working.
Right.
The HSA, which is a voluntary contribution by the individual, has not been touched. Okay.
Okay, so that's what flexible spending accounts only.
Yes.
Thanks for the
They're
clarification.
trying to push people more towards the HSAs.
You can tell, privatizing your medical care. Yeah. All right, so where are we seeing? Capital gains changes. Okay. Your income determines what capital gains rate you're in. I've seen a lot of confusion about this. And there are 3 possible rates now for 2015, okay? The 0% rate stays for those in the 10 or the 15% earned income bracket. So if you're under $70,700, you are still going to have a 0% potential capital gains rate, okay, for the portion of capital gains you take before you go into that higher bracket, okay? The 15%, which we currently have, stays. That stays for people in those middle brackets, if you will, the 25 to 35% bracket. But here is a new one. 20%. Now it used to be 20% just a few years ago, but it's back. 20% rate for those who fall in that top income bracket of 39.6. That's a big increase from 15 to 20. So for any people that may affect, that's that. Now we have some new income taxes that are directed towards Obamacare. I should be clear, this is not the fiscal cliff, so it's nothing to do with it. It has to do with the timing, right? It all happened kind of at this great time.
Sorry. I'm just trying to get that black.
Sports scores?
No, I'm trying to get that. I'm trying to get that too far off, but I don't want to.
Yeah, so,
Little lag.
There we go.
so here we go. There is an additional hospital insurance tax on high-income earners. Okay, in 2012, the rate was 1.45 on all earned income. So that 6.2% that used to be 4.2%, that only goes up to a certain level, 110, 120,000.
Now, this is not part of the 6.2.
So this is additional to that, right? Right.
Always been additional.
Yeah, right. The 1.45 goes all the way up, and now, if I understand correctly, there will be an increase of 0.9% added on for those people who are earning above these levels. Also, there's a 3.8% Medicare tax on net investment income at certain income levels for trusts, estates, and individuals. So some people could be looking at 23.8 versus 0 or 15. Right? So, this really hits people on the higher end here. Okay, once again, I want to show you this slide because I think it's really important. I'll let Ryan come up as well. All this talk about increases, I think it's really important to kind of put things again in a historical perspective as we start talking about specifically stuff related to making decisions whether you pay your taxes now or you pay your taxes later.
So as Alex just mentioned, there may be some opportunities for us to game plan and to do some diversification. If you look at the slide, it illustrates that taxes have obviously been a lot higher in the past. If you look at right now, we're in the lowest 10 percentile of tax brackets that we've been in historically. And then looking forward, we still have a lot of issues associated to our deficit. So if I were to ask most people, do we think that taxes going up is still a risk? I think most people would say, yeah, at some point, taxes probably are going to need to go up to pay for some of the debt that our government has racked up. And so, again, we want to take a look at some of these Bush tax cuts that were made permanent as an opportunity as well. I think a lot of times when we're talking about financial planning, commonly you'll hear diversification. And more so than not, normally the diversification that's addressed is asset location. How much is in stock? How much is in bonds? How much is in alternative investments? And that is a key piece to financial planning. But another key piece to financial planning is the tax diversification strategies that you can implement. And that can be implemented while you're working, but it also can be implemented at retirement time frame as well. One of the tools that we use for tax diversification, and when we talk about tax diversification, we're talking about how your assets are dispersed. If it's in a Roth IRA, if it's in a rollover IRA, if it's in a non-IRA account, how are those assets located, and then how are they going to be taxed as they're growing, and how are they going to be taxed putting the money in, and how are the taxes going to apply taking money out of these different accounts. With Roth IRAs, Roth IRA is a retirement account that can be used, and it allows you to put in after-tax dollars, allows the assets to grow tax-deferred, and then when you pull the money out, it can be tax-free. Now, the government doesn't let everyone contribute to Roth IRA, and they have limits in regards to, number one, you have to have earned income. So a lot of times we'll have clients that are at retirement say, I want to contribute to a Roth, and we'll say, well, you don't have earned income. And I'll say, well, I have income coming in from my pensions, from my Social Security benefits. And those aren't actually earned income. So we cannot contribute to a Roth IRA unless we have that earned income. So for our clients that are still in the accumulation phases, contributions to Roth IRAs can be very beneficial. In regards to those clients that can contribute, the IRS has tacked on some additional rules in regards to who's allowed to. So if your income is at higher levels, then they start to say you either can't contribute or they phase out how much you can contribute. So this slide illustrates what you can do for 2012, and based on if you're filing single, married, and filing joint, or married and filing separate. You can see that married and filing separate, they pretty much don't allow you to contribute for the most part. For those clients that can't contribute to Roth IRAs because they don't have the earned income, or maybe that they want to try to get more money into Roth IRAs, they can do another strategy through Roth conversion. And prior to 2010, if you made over $100,000 as single or married, you weren't allowed to do conversions. And the way conversions work is that if you want to try to get money from a 401k or a rollover IRA and moved over to a Roth IRA, you can do that. And if you convert over those assets, the amount that you convert will be taxable as income in that given year that you convert. So if you want to convert over $50,000, you can do that. But that $50,000 will be taxed as earned income in that given year. Again, in 2010, they lifted the income rules. Now anyone can do conversions. And again, it's unlimited. You can convert over $1 million if you want in a given year. Obviously, that's going to have some impact in regards to your taxable income, so you want to weigh out if it makes sense or not. But a lot of times we'll see situations where our clients have assets that we know they probably are going to be transferring over to their kids or to maybe someone else in their family. And they have enough assets where maybe it makes sense for us to convert over some of these assets from an IRA over to a Roth IRA. So these assets can continue to grow tax deferred and grow tax free and can be passed on over to their kids as well. A few pieces of why this can be beneficial. Number one is rollover IRAs have the 70.5 rule, so they have the R&D requirement. And so sometimes we'll have clients where they have assets in their portfolio that they may not need to specifically access, and they want to leave their dollars in their IRAs, but once they turn 70.5, they're required to take out a certain amount out of these IRA accounts. That's the R&D requirement. If you don't pull out that requirement, then there's a 50% penalty plus a tax. So you get into a situation where you might have to start stripping money out of your IRA accounts and move it to non-IRA accounts. Now it's not growing tax deferred. And it also, in the years that you're taking RMDs, it can bump up your income, which may also push you into a higher tax bracket. So planning for conversion can make a lot of sense. And it also makes a lot of sense to address this earlier on, because as we start to transition into retirement, there's other pieces that we'll have to look at to see if it makes sense or not. It can increase what your Social Security benefits, how they're taxed, what portion of them are taxed. It can also affect in regards to Medicare premiums if you have to pay more in a given year if you're doing conversion. So it's not as simple as I just want to do a conversion and it makes sense. It's let's run the figures to see how this is going to affect your overall tax bracket and then trying to figure out what levels it might make sense to. Often when we're doing conversions, we talk about the marginal tax brackets. Commonly we'll want to try to take a look at these limits and see where it's going to make the most sense to do conversion. Now, go ahead.
I was just thinking, this relates back to that slide that Alex had earlier about the periodic table and the asset allocation stuff. One of the things we don't talk about a lot that we probably need to talk about more is picking and choosing when you're doing a Roth conversion, because that IRA may contain some assets that have been trailing in performance for the last few years and are now poised to see a significant growth. We can get them into the Roth before the growth really starts to take off.
Right.
All the growth is tax-free.
Great point.
So an analysis of not just the dollars, but specifically which assets you're moving can really make a big difference, too.
And we saw a lot of that take place with conversions that in the last couple of years, and Steve's going to touch on this, but there's still considered to be some discounts in the market. And there may be specific assets within your portfolio, like Margaret mentioned, that would be great potential for conversions. This next slide talks about 2013 and the income limits associated to contributing to Roth IRAs for 2013. Now, you can back fund Roth IRA contributions, so technically right now, if you're, and this will hit on the next one, you can actually contribute for 2012 and 2013 now that we're in a new year. And so if you have assets that are in non-IRA accounts that you'd like to have invested, or maybe they are invested but they're in non-IRA accounts that you'd like to try to transition to be more tax favorable, this could be a good time to address, again, for 2012 and potentially 2013. The limits associated to IRAs are now $5,500. Last year it was $5,000, and there is a catch-up provision associated to those that are 50 and older. So again, if you wanted to contribute for each individual, you could do $10,500, or if you're over 50, you could do $12,500 for each person. And obviously, when you do that, you want to make sure that if you were to fund for 2012, you want to make sure you report that on your tax returns, and you want to make sure that it's funded before the tax filing deadline, not with extensions either. The next piece, another strategy that can be used for tax diversification tools, is the 401k plans. So we can get pre-tax benefits associated to 401ks, the 403bs, 457, and that limit has also been increased. So now the maximum that you can put in is $17,500, and there is a catch-up provision, which is still the $5,500. Another piece associated to this, in the last few years, a lot of 401k plans have introduced the Roth provision to the 401k plan. So now you can actually do these full amounts to Roth 401k. So if your income is too high to be able to be eligible for the Roth IRA contribution directly, you have the ability to fund your 401k plans, and if your company provides it, not all 401k plans provide it, but if they do, then you can use their Roth provision. Something else that was added this year is now we can now start to do Roth conversions within the plans. So that's brand new this year, that we'll start to see these plans starting to open up for clients. And a lot of our clients in the past said, you know, I've been putting into 401ks for years, and they don't have the Roth provision, or they weren't eligible to move those dollars outside of the plan because their plan didn't allow them to move or do in-service rollovers, and they didn't have the ability to do some of these tax credits. Now with this new law that's been placed, we're going to be able to actually execute some of these tax strategies, some of these tax diversification plans within the 401k plans themselves. So that is brand new to this year. And with that, I'm going to hand it over to Steen, and he can go over some of the opportunities associated with the market.
All right.
Thank you.
I'm not going to get too much into this because we've got the Market Insight webinar coming up on February 7th, a shameful ploy here to market that. I expect everybody here to log into my webinar on the 7th of February at 5. So I kind of want to rewind back to that night at Monty's Steakhouse when we had 80 people in the room and everyone was freaking out. Everyone was coming up to me, and Alex and Ryden, and asking us, well, what are you guys doing? What should we be doing? We had people emailing us in, should we stop our 401ks, even though they were getting matched dollar for dollar on their 401ks. They were so scared of the stock market and what their account had done that they didn't even want to put more money into it and get free money added by their company. So it was obviously a time frame when the markets were dislocated. The market was trading based on fear. And we have been 4 years removed from that now. You can see that a lot has changed since that day when we were at Monty's, which was some day in October, actually. But the market hit the bottom on March 9th, 2009, which was 5 months after we had that talk there. Since then, the market's gone up about 115, 120%. These numbers are to the end of the year. January's been very kind to us so far. when they finally did decide on the fiscal cliff deal. The markets applauded that. We're up 3 to 5% in about 2 days, depending on the asset class. The reason that we have this chart here is just to show you how different it is. It looks pretty similar. I mean, if you look at this, we might get worried that we're ready for. If I look at this and I'm, just saying, okay, well, what's next? It doesn't look so good. We're down 50%. That's what should happen based on this chart. But what these little numbers say that you guys cannot read from there, but you can read on your presentations there. March 2000, we took the index, this is the S&P 500. We looked at the PE ratio, the dividend yield, and the 10-year Treasury. Just to give you an idea, the S&P 500 was at 1527 on March 24, 2000. That was the market high back then. The PE ratio, price to earnings, what people will pay for an earnings stream, was 25.6. Historic PE ratios for equity markets are 16, 17. So we had a PE multiple that was 25.6. That's a very expensive market. You're not going to pay 25 times earnings in a normal market. If we go back to that period of time, it was at the end of the 90s, the 80s and 90s, we had a huge bull rally in stocks. People could throw a dart at a dartboard and make 100% in 1998, 99 with some of these tech names. The market was very overbought. Everyone was crowding into stocks. 26, almost a 26 PE multiple. At that time, you got to tell yourself, and the reason I'm spending so much time on this right now is because we could get to a point where we see PE multiples above 16. If we get to that point, we need to be the folks who say, I'm not going to get caught up in this stock market that's earning 30% a year, 40% a year. We're going to be the people who are selling stock at that point and buying some other asset classes that might not be doing as well. Because markets will go way too far one way and then way too far in the other direction. So fast forward. We go through a recession. No one wants to be in the stock market. We have a little bit of a recovery, and then we have the financial crisis. Before the financial crisis, we got right back up to 1565. We posted a new high. We were not there for very long when mortgage-backed securities, real estate, banks, Lehman Brothers, Bear Stearns devastated the markets. And at that point in time, we were at a more normal PE multiple. If we look at the PE ratio, or the PE ratio was at 15.2 at that time. The dividend yield was at 1.8, and the Treasury was at 4.7. Those are all pretty historic norms. You wouldn't, think that it's overvalued, undervalued, which is what we all thought. Everyone thought that. And then you throw in this, the banks were leveraged, and we had subprime, and we were, everyone was buying a house, and houses could not go down in value, of course. And then we have what we know as the financial crisis. And we went on a 57% downturn before we finally started to have some sense of, okay, the world is not going to end. And now we're up 111 points, 111% since then, end of the year. If we look at the equity markets now, we have a PE multiple as of today. The S&P is at 1471. If we look at what the PE multiple is, it's at just under 13 as a PE multiple. Dividends are at 2.3%, and the 10-year Treasury is at 1.8%. So if you look at bonds versus stocks, stocks still look very attractive. If you look at the inverse of the PE, which is the earnings yield, you're getting a 9% return if you just collect the dividend. If you buy a stock, in 1 year, you're going to get 9% of your investment back as a dividend, regardless of what the stock does. That's compared to bonds. If we were to draw a graph and look at yields of bonds versus the earnings yield of the S&P, that's historically never been that big of a gap between what bonds are yielding and the earnings yield of stocks. Back in 2000, when we were at the high, it was exactly opposite. Bonds were earning a whole bunch, and the earnings yield was really low, and the gap was exactly opposite of where it is now. So we still believe that there is value in equity prices. We believe that, if you want to go ahead and fast forward the slide, stocks are a very attractive investment right now. Positives within the current environment, real estate. Finally, we have some bottoming in real estate. We actually have prices going up. You know, Phoenix, we're in a very good market. We actually had a #1 price return for the past 1 year of all the top 20 cities that are in the Case-Shiller Index. Around the country, it's starting to loosen up. We're starting to see new homes being built again at a much higher rate than they were 3 years ago, but we're still below where population growth should be. We should be at around 1.1 million units per year of new homes being created because of population growth. We're at 850,000, call it, new homes being built right now. In the doldrums, 2009, 2010, we were at about just under 500,000. So for 3 years now, 4 years now, we've been at a deficit of homes of 500 to 600,000 homes every year that we need that are not being built. So that's pent-up demand that's been building for the past 3-4 years. That's going to start to help the economy as we get through some of these issues. Same thing with autos. For 3 or 4 years, we were below the scrap rate in autos. The scrap rate in autos is about just over 13 million units, and we were running at below 10 million units of what we were producing for the car manufacturers. Autos are back up to normal. At the end of last year, we were on pace to have a 15.5 million unit year. If we were to fast forward it twice, we were to get that month, 12 months in a row, we'd be at 15.5 million. So that's a good sign. We're back up, but we still have some work on the housing. So housing and autos are going to be tailwinds for the U.S. GDP. Consumer sentiment. Folks are getting more positive, minus this fiscal cliff. We kind of had a bounce down for a little bit. We've kind of had a bounce back up. But before all the fiscal cliff talk, consumer sentiment was really improving, and that has a lot to do with PE ratios. They're very correlated. Strong manufacturing, strong non-manufacturing. The ISM numbers have both been over 50. For a while, manufacturing, we had a little dip, but things look very good in both the manufacturing and non-manufacturing sectors. Pent-up demand, I was talking about that. Things that we do worry about, and you know, back in 2000, we could have been talking about things that we were worried about, our PE multiples of 26. Well, today, we're not worried about PE multiples of 12.5, 13. We are trying to tell people, don't be so scared of equities. Look, we're getting 2.3% in dividends to be in equities. I'm not saying that we should put the whole portfolio. We need to follow your investment policy statement, make sure that we can hit your goals with the highest probability. But there are a segment of folks out there who have their entire portfolios in cash and bonds and maybe gold. Well, the things that worry me the most are bonds and gold and precious metals. Anything that has had a very, the Federal Reserve has distorted those markets tremendously. Their balance sheet has over tripled in size since 2008. They printed money, or actually they just created it electronically. They bought treasuries, they bought mortgage-backed securities from the market. So they're pouring cash into the market, and they're buying treasuries and mortgage-backed securities. If we have a huge, just think of the biggest purchaser out there of anything, stock, gold, cows, whatever it is. If you have a huge purchaser go out there and purchase a whole bunch of whatever it is, what is that going to do? In bonds case, it's going to drive bond rates down and prices up. Yields are inversely related to bond prices. So as a yield goes down, the bond price goes up. So if the treasurer or if the Fed is buying treasuries, buying mortgage-backed securities, that's artificial demand for these securities. The prices go up, the yields go down. The reason they did that is because the number one problem with the economy was housing. I talked about that just 5 minutes ago. So Ben Bernanke, I'm glad that we had him in the Fed when we did. He is a student of the Great Depression. He's the perfect person to have in there. But we're past that now. It's time for them to start loosening it up. And we've already started to hear it. The Fed is usually late to start to react. The bond market is going to decide what happens. When the Fed stops buying treasuries and mortgage-backed securities at the pace that they have been, and the bond market starts to see this, rates are going to come up much quicker than I think a lot of people are expecting. When rates come up, your bond prices go down. So all these folks who have moved out of equities into bonds, and they think, wow, you know, I'm clipping away. Bonds have done great over the last 30 years. The reason? The 10-year Treasury has gone from 15 to 1.5. So when interest rates go from 15 to 1.5, you have a huge tailwind. Your bond prices are going to go up. You're going to get the coupon. You're loving life as a bond investor. If interest rates were to do exactly the opposite, you do not want to be near bonds. I'm not saying that interest rates are going to go from 1.5 to 15, but if they go from where they're at right now, 1.8 to say 4 or 6 over a short period of time, bond investors will get hurt. And then we'll see people flooding away from bonds into something else. And the same thing is happening with precious metals. The Fed has increased its balance sheet. Gold has basically moved directly in line with the size of the Fed's balance sheet. No one trusts all these. It's not just the Fed either. It's the Bank of England, Bank of Japan, the ECB. All of these central banks are doing the same thing. It's a fight to reinflate everyone's economy, to try and get the economies moving. They're starting to work, but what we fear is not something in the stock market. It's something in the bond market and in gold, and folks who are too overly allocated in those two areas could get hurt. And that could cause income for investors, you know, who are in retirement, who have a big portion of their portfolios in these fixed income portfolios. It could cause them to take a little bit of a bath, and then that could have an effect on the economy, which then would have an effect on stocks. So those are things that I'm more worried about versus just being in stocks for the right period of time, getting a 2.3% dividend, and so on and so forth. So these guys always, you know, make me do a prediction at the beginning and end of years. Last year, my prediction was 15.25. Wasn't looking so good. When the year ended, we ended at about 14.25, so I was about 100 points off. But now we're at 14.75 almost. So we're getting there.
You were 3 months late the previous.
I was 3 months.
3 months early or late, I don't know.
Late the year before that. So I think whatever I say, it's going to happen 3 months after. It's going to happen in March of 2014. But the things that we're looking at, we believe that the S&P 500 could easily get to 1,680 by year end. And we are very optimistic that we'll hit the new highs, which would be 1,565 by mid-year. After the debt ceiling, February 15th-ish, and after the sequestration of the debt, you know, how they're going to actually figure out which spending cuts they're going to have to do. When that gets past us, I think we have a window of time where we really could see the equity market start to pick up. Bond funds are still outpacing equity funds. We had a huge month in December for equity funds.
Talking about flows.
Flows into bond funds are still outpacing equity funds, but December was one of those turning months. And that's, one of the reasons why December was so good. The first couple of days in January were so good. We believe that continues. Institutional investors who are managing pension funds and other folks' money who are beneficiaries of these funds, they need to be in equities for longer periods of time. Markets are becoming more normal now. You have another phenomenon. When you get back up to those new highs, you have folks who got out at a certain point, whatever that point was when we were coming down. We've met with tons of people like this. They're like, I went all into cash when the Dow was at 10,000. Well, Dow went down to 6,000, and then it came back up to 10,000. Do you think those people got back into the market at 10,000? Or do you think they waited? And now we're at 13,500 or 1475-ish on the S&P. When do those folks get back in? Well, they get back in when people start to talk about stocks again. And we're getting closer to that. That phenomenon, just getting people to just invest in stocks again, is going to be a very big tailwind for stocks. And I believe after we get past this debt talk, the debt ceiling, and the spending cuts, we have a window period where we could see the S&P do very well into the middle of this year. So we're very optimistic, but at the same time, you all have different goals. Everyone who's listening to the call has different goals. So we're not here to say go 100% into stocks, go 100% into bonds. It is about diversification. You'll always hear us talk about that. It's about your risk tolerance, your risk willingness, and your ability to take risk, and really combining those two so that we can build a portfolio that no matter what happens in the future, if I'm wrong, if other economists are wrong, I'm going to be wrong eventually at some point. You cannot predict what the market does, so we need to start with a balanced portfolio. If I could predict what the market could do, I'd be on my yacht, day trading on my internet out there, and be living a good old life. So, it's very hard to do, and no one's really successfully done it. Otherwise, we would know about them.
Yeah, that's true.
The rest I'm going to leave for the webinar. That's probably more than I even thought I was going to talk about. So at that, I'll open it up to questions. Tom.
Ian, I know you said you wouldn't predict. You threw a number out for the S&P 500.
I did.
What's going to be? Can you give me a percentage increase in the S&P 500 for the year 2013? Ballpark.
I'll give it to him.
All right.
Let me see.
Wait a minute, I didn't ask you.
20%. 20%.
Go.
He's sandbagging.
I think it's like
Great. It's roughly what it was in the past year, right?
Numbers. It was 16% what we just had. But I don't look at the. That's not how I come to that number. I come to that number by trying to figure out what the S&P earnings are going to be.
Okay.
And so, let's say we have $106 for S&P earnings. I've had low estimates of 100, high estimates of 112.
Okay, plus or minus 10%. Okay.
So you get 106, and then you multiply that by a PE. I think we can get up to 15 as a PE. So, it's somewhere between 14, 20 at a low PE multiple, 100 to 112, to a high PE multiple of 16, 17, which I doubt we'll get to that in such a short time. It could happen, but I really doubt that. If anything, I would look at earnings and say, okay, earnings might do better than 106 to 112 dollars a share. I look at that more on a 15 or 16 multiple to try and get the best case scenario. Kathy?
Seeing if we all wanted to listen to a ratio or a number to really gauge what's important, would it be GDP to debt or GDP to deficit? What number really says
For
how far
the economy, I look at GDP.
to
What's that?
ratio?
2.5%.
Okay, but to debt or to deficit or what?
No, GDP. Just GDP.
GDP growth.
GDP growth. GDP growth. Growth rate of GDP. So for the longest time, we were at about 3%. And basically, there have been a lot of studies done, a lot of research done. An economy like China, they're growing. Their population growth is astounding. And that's why they can grow at 7, 8, 9, 10%. That was the U.S. 45, 50 years ago. But we're not growing, where our population growth is not growing like that anymore. You can look at population growth and see that in 1985, there was a shift in population growth. In 1985, there was also a shift in GDP. We were used to 3 and 4% for the longest time. 4%, that's the average GDP. 1985 to now, our average is 2.5%. Just so happens to measure up exactly with when the population downshifted. So there's a lot of studies that combine, that look at, and it's basically population growth. That's kind of our average speed limit, 2.5%. So if we're above 2.5%, the economy's growing pretty well. If we're below 2.5%, economy's not growing as well. But GDP figures, they fluctuate, and so you want to look at a little bit longer periods of time. Back in the third quarter, it was 3.1% GDP growth. Probably going to be a little bit lower, closer to 2% for the fourth quarter, although we won't know that until the end of this month. But it's not as simple as looking at one figure, but if I were going to be looking at if I only could look at one figure, I probably want to know what the GDP growth was growing at.
I think I'm asking that because the world is coming to an end if we don't do something about the debt or the deficit, and so
growth is much more important. And when everybody's talking about the end of the world or U.S. is going to turn into Europe or Japan, or they're talking about the GDP to debt ratio. Growth helps that ratio tremendously. The things that Congress just did helped a little bit. They're projecting our debt to be at 72%, or the debt to GDP ratio at 72%. There's talk that once you get above 80, 90, that's when it's a problem. We're not there yet, and what they've done would hopefully, if everything goes, they plan these things 10 years out. So growth is the biggest driver that no one can predict. That's going to change that number much more than them changing tax rates like they have, or if they decide to change deductions, which they may decide to cap deduct. We don't know what they're going to do over the next couple of months, but they could certainly do something like that.
Question, isn't the spending habits of the average American or the population the key ingredient to growth? That's a big driver, isn't it?
Consumer spending for the U.S. is roughly 70% of GDP growth.
So the fact that you mentioned automobiles going up, you don't have to look around too much to see everybody's driving a new car.
And housing, and that's why I give a lot of credence to those, because those are the drivers of GDP.
Right.
And so Kathy says, which one should I look at? Well, you want to look at GDP, but really you want to look at the things that are underlying, housing.
Well, people decide to buy a house, they decide to
capital expenditures, all of those things have been going in the right direction. If we look and we say, okay, do you think there's a risk of us going into some recession? I can't think of many things that would put us into a recession other than the fiscal cliff, or if they do something that would hurt consumers tremendously, the payroll tax, we're going to have to see how that plays out. Short run, that's our biggest risk is how do people change their spending habits when they have less money? We're going to know that here pretty soon. So offset that. Have you guys filled up your tank recently?
Not right.
Have you noticed gas prices have gone down tremendously over the past 3 months?
Demand has to have gone down.
Well, there's a lot of things that play into that, but that's going to offset that payroll tax hit slightly. And there's all these things that are moving. But when we look at all of them separately and together, I can't really paint a scenario other than the two things that have done, I classify them as the two things, but precious metals and bonds. If there's anything that I worry about, and the Fed's balance sheet is like, star asterisk, everything. That's what you look at that and you're like, whoa, that's, we've never seen anything like that. And what is it distorting? What other things is it distorting? Because we can see that it's distorting the bond market. We can see that it's distorting the gold market. If you look at an inflation-adjusted price of gold, gold doesn't do anything. It's a store of value. Yet it's gone up, from $400 an ounce to $1,600 an ounce in a very short period of time.
Is there any limit on how far the Fed can go? I mean, they've got, what, $4 trillion on their balance sheet now?
Right.
Can they go to $16 trillion? I mean, does it matter?
At some point, it does matter.
Well, what happens?
At some point,
clearly, spending more money would make a lot of people happy. So, what's the boundary?
Well, there is no boundary. It's how much treasuries they could buy. What's going to happen is if they went and did that, they're worried about two things: growth and inflation. And if they did unlimited buying, inflation's going to go skyrocketing. And that's going to be a much bigger hurdle for everyone because now milk is more expensive, gas is more expensive. All these things that we use every single day are more expensive. That's a tax that no one knows about. It's a silent killer. If we look at the number one risk of most of our clients, and I'm doing a very broad brush here, but I would say if we looked at all of our clients and said, okay, what's the biggest risk to all of your clients? I would say the number one risk is inflation risk. If inflation went from where it currently is, just under 2%, up to 6%, that's a huge, and we need to make sure that we're protecting against that. You know the best thing to protect against that? Real assets. So real estate, commodities, stocks. The worst things to own during an inflationary period of time are fixed income. You do not want to own fixed income in inflationary times. Interest rates are going up. Prices are going down. So, long-winded answer, but Ned?
Yeah, what role does GDI play in this, and what's the trend?
Say that again?
What role does GDI play in this, and what's the trend?
Gross domestic income?
Yeah.
It's just a subset of gross domestic product.
Yeah, but what's it looking like? I mean,
it's following they're almost directly correlated to GDP. Yeah, and it's very similar.
Okay.
Any other questions about taxes or?
Well, I heard the thing the other day from one of the fabulous guys in Congress that he wants to propose a energy tax. And he wasn't really specific on which part of the energy is all of energy. So if they start taxing that early, that's really going to put it down to something.
Every decision that is made has other repercussions, right? And one of the things that we're trying to do is stay ahead of those and to protect everyone from multiple.
This guy was basically saying we have to pay for Obamacare, and this is how we think we should do it.
Well, one of the ways they're doing it is by adding investment or the investment income tax,
Yeah, but
surcharge.
That's different. That's like this.
Touch it.
I mean, it's so minuscule of what they bloviate out of. It's nothing, okay? And so they know that that's just nothing. It's not going to pay for anything they're doing, okay? And that's why this guy came out. At least he was honest about it, okay? So yeah, we're going to have to raise energy taxes to get this money.
Yeah, and I encourage everyone. I'm not being political at all. We all need to be more informed on what's really happening. If you look at, and this is not, I'm not saying anything political here when I say this, but 46% of our annual deficit is Medicare and Social Security. 46%. Another 6% is interest from just our overspending each year that we've accumulated. That 6%, if interest rates go up, is going to go up. So between those three things, interest and entitlement, that's 50% of our annual deficit. In my opinion, we need to look at those programs and find ways to keep them for the right reasons and for the right people and adjust them so that they can be there for generations to come. They can do very simple things, and if you guys want, we've got a great piece that talks about Social Security, and it gives some options. It's a third-party research team that did it from Boston University, I want to say, I believe. I might be wrong. It's either Boston College or Boston University. You remember? Anyway, it's a great piece on how to fix Social Security. They run through everything about Social Security. If you want it, email one of us and we'll get you a copy of it. I can't remember what website it's on, but it's a really quick read. It's about 40 pages, but it's huge type, charts, pictures, very easy to get.
Everyone wants a copy of it.
And it's very informative, and I think everyone would get a lot out of reading it. Okay.
Every once in a while they talk about, in order to raise revenue in the future, they may have to tax the 401ks and IRA. Any opinion on that?
Well, they tax them already.
But I mean, they may change the rules in the future.
And they can, I mean, we're, right. They can do any, they can change any rule, but they have to also get elected.
Well, that's not hard to go ahead and like them to cheat.
Yeah, I mean, we've got to live with what they make law. I think it would be, I think one of the things that comes up a lot is, what if they change tax ramifications on Roth IRAs? I think that it would be tremendously hard for them to tell somebody who has already paid tax, gotten it out of the way, to pay tax again in some sort of form or fashion. Politically, that would be a very difficult sell, and I just don't see it happening. And I basically, for my own planning, I've been funding a SEP every year and converting it to Roth and paying my taxes now because I believe that taxes are going to be worse down the road. I'm going to end up having a couple of buckets, just like hopefully everybody here has some IRA, some Roth, some taxable, so that no matter what happens, just like our investments, you can throw up that periodic table. And I did want to make one comment about Margaret's comment. You throw up that table, you can't predict what asset class is going to do well. We can say, yes, emerging markets or international is undervalued based on history of what people had been paying for it. That could take 3 to 5 years for that to happen. Now, we made that change in August, and international has done better than domestic by 10% since we've done that. We got lucky. It was not, sometimes it takes 3 to 5 years to see those things. But one thing that I did want to point out on Margaret's comment is everyone who is converting IRA to Roth, we specifically pick certain assets to convert, not because we know what they're going to do, but because over the long run, those assets are the ones that perform at the higher levels so that you can have the great growth in your Roth IRA. We also do that with taxable accounts. We say, okay, it's a taxable account. We don't want to own bonds if we don't have to, or anything that's tax inefficient. We don't want to own that in a taxable account. We would like to own that in an IRA or a Roth IRA. So depending on your assets, where they fall in those types of accounts, part of our asset management is figuring that out. And so you guys might look at one account and be like, this account's only up 5%, when this one's up 25%. I want my whole portfolio on this one. We've designed it that way because we're looking at all of your accounts, and this is not always the case because some people have multiple goals, but we look at all the accounts for that goal and build it like that, and then own the correct assets in the right accounts. So I did want to follow up on Margaret's comments on that.
I knew that's what you were doing. I just
Right.
don't think we talk about it.
Right.
That's
And we've been doing that for 5 years now, and it's now just starting to become, we're starting to talk about it more because of all these tax changes, and folks are, worried about their taxable accounts, and oh my gosh, my dividends are this, and and we're really know that in the background we're trying to minimize your tax. I should say that we are trying to maximize your after-tax rate of return in your pocket at the end of the day. So if that means owning a municipal bond in a taxable account and owning a taxable bond in a Roth IRA or an IRA, that's what we're trying to do with the least amount of risk to hit your goals. That is what we're trying to do. So,
can I just add on to
yes.
what you said about the politics of changing the taxation on retirement accounts? I think there's an even bigger reason why that is unlikely to happen. I mean, first of all, the easiest thing they could do would be to freeze or lower the upper limits that you can put in, okay, without making an actual tax change. I don't think they're going to do that. I think, in fact, we're going to continue to see them go higher. And the reason I say that is because historically the savings rate in this country compared to the rest of the more affluent countries in the world is absolutely abysmal.
Right.
And we know that Social Security and Medicare are in trouble. So what's the best hope for the future generations? Encourage them to build up their retirement assets so they won't be so dependent on Social Security and Medicare. So why would you cut back on what you're letting them put in? You should be jacking it up, not cutting back.
Right.
But you're talking about rational.
But not all the decisions appear to be rational.
No, I know, but very reason, in addition to what Steve said about the politics of it, I don't think we're going to see it go that way, because I think they're, even though sometimes they're a little goofy, the fundamental realization is that really is true, that you need to encourage savings. And if you look at even just Canada to the north of us, at the time when the ability to put IRAs, or money into IRAs in this country was still in the 2,000 range, they were up in the 10s.
Really?
And that's because they had a different mindset towards savings. And I think we're catching up, and I think we're going to continue to see those limits go up. Maybe just index for inflation, but they'll keep on going up. I don't think we're going to see them cut back. I'd be very surprised.
That's a great point.
Yeah, I commented on this once before, but one of the things, and Margaret might have an opinion on this, but one of the things you probably ought to think about doing is what you're doing, convert as quick as you can.
Right, right.
Because if you do that when you're 63 or older, you're going to get that Medicare tax hit you pretty hard. So I always suggest you look at doing that if you want to make it happen.
There's a window for some clients who are early retirement, 55 to 62, depending on when they want to take Social Security, when it makes sense to take Social Security, Medicare. There's a window there where we can do a lot of Roth conversion, and we work with Margaret on a lot of these. Where, we're sending her all the data she needs. The client is sending all their data, and we're trying to figure out, because this is something that we have to do in the previous year. It's not like a contribution where, it's what's today, the 16th, January 16th. I want to make a 2012 Roth contribution. Well, I could do that right now, but I can't go back and do a conversion for 2012. So it's something we have to kind of play with and estimate. But yeah, between 55 and before Social Security, before 63, when you've got that 2-year look back, those are good times to start looking at Roth conversions. They can be very powerful for down the road.
That's a great point, Ned.
I think that's it. Thank you guys for coming. We really appreciate it.
Yeah. Hey, Ryan?
Red button now. Stop recording.
Covered. Here we go. Yep.